So I'd love to get into a few other questions from the room. We have a question from Ira. He says, can bond, mutual fund, and exchange traded fund prices be expected to decline with each future Fed rate increase, or are expected rate increases already built into the current prices?
Good question, Ira. It's a good learning opportunity here. I wrote a book called Investment Mistakes That Even Smart People Make and How to Avoid Them. It covered 77 mistakes that investors make, even professional investors. And one of the most common one of those 77 is that investors confuse information with knowledge or value relevant information that you can use. So what that means is the following: information is just a fact, an opinion, whereas value-added information is something, a fact that you can use to exploit and generate a profit. So, for example, if the New York Yankees are playing the Kansas City Royals, the odds are very heavily favored that the Yankees will win, given the differences in their payrolls. The Yankees are likely to win about 100 games or so this year, in Kansas City, maybe 60, something like that. But you can't use that information to make money betting on the Yankees, because everybody knows that information. It's embedded in the price, and you might have to, say, put up $10 to win $5 if you bet on the Yankees, and that odds would equalize the risks of winning. The same thing is true about stocks, and this is what I try to teach people. Someone tells me, Larry, you got to buy this stock, or you hear Jim Cramer give you 20 reasons you should buy the stock. And my first response is, gee, I just heard this on national television. This must be a secret that nobody knows. The smart people at Goldman Sachs, Morgan Stanley, all the hedge funds are totally unaware of what Jim Cramer just told the whole world. Now, when you think about it in that way, that sounds ridiculous. And that's why Jim Cramer's picks don't outperform the market. He doesn't know anything more than all the sophisticated investors in their collective wisdom know in setting prices. So the answer to the question is this: it is only new information that is a surprise that matters to stock prices. And a great example of this is if, as I point out in my books, think of a company, let's say during the financial crisis, General Motors announced earnings were down 20%, but the stock dropped. The stock jumps 5% or 10%. Now, why does that happen? Clearly, down 20% earnings announcements are bad, but the market may have been expecting much worse. And therefore, the stock went up because the news, while bad, was better than expected. And the same thing happens when earnings go up, say, 100%, which clearly is great, but if the market was expecting more, then the stock price falls. And here, what we would likely see is if the Federal Reserve were to raise interest rates more than the market was expected, and you can tell what they expect by looking at the yield curve. And if that happens, then the market says something like, boy, the Fed is really more concerned about inflation than we thought. They're going to have to tighten more than expected. And therefore, stock prices might go down and bond yields might go up. On the other hand, if they only raise it, say, by 25 basis points, when the market is expecting 50, it might have a very different reaction. So what you always have to think about is this: the only thing that matters is not whether news is good or bad. That's totally irrelevant, although most people don't understand that. The only thing that matters is the news better or worse than expected? And I'll give you one last good example. March 9th of 2009, the stock market bottomed out and went on a big tear for the next decade, basically, despite the fact that the economy was still in a recession in the next quarter. The unemployment rate stayed at 10% and actually went up a bit more between then and the end of the year. But the market jumped dramatically and went up again the following year. The reason is that while the economy continued to do poorly, unemployment continued to rise, the news was not as bad as the market was expecting. We didn't enter a Great Depression. We began to, bottom out and recover. So given that the only thing that matters are surprises, and by definition, surprises are not predictable, that's one of the main reasons why active managers find it extremely difficult to outperform. There just aren't these legends who can predict better than the collective wisdom of the market. So I hope that answers that question.
And the lesson that I learned from Larry is Buckingham offers a set of what they call the alternatives. And I like two of the alternatives, and I don't want to get into those, but the one that I did not like was a reinsurance alternative, which basically was a company that, let's say, helped insurance companies cover their losses. And I thought, oh, gee, with climate change and all the problems that we have and the forest fires, these insurance companies are going to get crushed, and anybody who was helping, in fact, cover some of those losses, they're going to get crushed. So, Larry, I like the other alternatives, and you've convinced me that they're going to most likely get much higher than bond or fixed income rates, with maybe not as high as stock, but with a lower risk. But reinsurance, I don't really like that. And Larry was much more eloquent than this, but the essence of his answer is, oh, so Jim, you think you know more than the PhDs who are studying climate change, who are studying and can quantify it, when all these reinsurance rates have gone up dramatically because of that, which means that there is more money for the reinsurance companies to pay these claims. You think that you know more and you can outguess these people, and you're going to make investment-based decisions based on your gut instinct instead of the evidence-based that these people that really know what they're doing. And I said, okay, Larry, you're right. Now, maybe if I was an insider and I had special information, by the way, it might even be illegal, if I had that, that might be another issue. But I think Larry's point is that if we don't have any specialized knowledge that the market doesn't already know, we're not going to be able to outguess the market. And I actually liked your analogy of the Yankees and the Kansas City Royals, although if you're talking about losing baseball teams, I don't know why you didn't pick the Pirates.
Yeah, I was trying to avoid the Pirates.
Well, Pittsburgh's on an upswing. We beat the New York Rangers in the third overtime of the first round of the Stanley Cup last night. So, okay.
Jim, so here's the thing. I think it's worth the audience hearing that. So everyone knows, all the scientists know that the climate change is impacting risks. Certainly it doesn't impact earthquakes. So that risk shouldn't change. And that's one of the big risks covered by reinsurance. But it does cover things like fires and floods and tornadoes and hurricanes. So if everyone is aware that the risks are greater for that, then that's going to be embedded in the prices. The reinsurance companies, if they believe that the risks are higher, they're not going to underwrite without charging more. Now, that doesn't mean they still can't have losses, because they understand they're modeling it to an expectation, an average over a long term. And we can have periods like we had in 2004 and 2005. We had two very bad years for the insurance industry. And then guess what happened? In those 2 years, by the way, there were 7 class 3 or more hurricanes landed in the US. So the insurance industry had bad losses. Of course, what happened? Premiums jumped way up. And the next 11 years, there was not a single landed hurricane of major class 3 or more. And the insurance industry went on to record profits. And then, of course, investors chasing those profits, cash came in, premiums came down. And then we had 3 bad years, 18, 19, and 20. Cash leaves out. Premiums are now California. If you can get insurance, the premiums are like 60% higher. They've also tightened underwriting standards. You can't have any trees within 30 feet of your home, and then brush has to be cleared another 30 feet. Building standards are tightened so that you have to have better construction to get the insurance. This is what happened today. Premiums are dramatically higher where the risks have gone up. And in fact, while, for example, the typical 60-40 portfolio has gotten hammered this year, with the S&P down about 13% and international equities providing not much better. They're down about 11. But at long bond, the safest treasuries that tend to do well when stocks do poorly, they're down like 20% this year. But reinsurance happens to be up. The funds we own are up several percent this year. So that's what happens. They go in cycles. And what the important thing is, you want to diversify your risk. So we don't make huge bets. We don't have 30% in reinsurance. We might have 5% and 5% in a bunch of other alternative assets in that manner as well. So the key thing again is, don't think about what you think you know. It doesn't matter what you know. The only thing that matters is you know something that all the top physicists and mathematicians who are analyzing this stuff don't know. And the answer to that is, if you know something they don't know, you might think about what happened to Martha Stewart, who tried to exploit that.
So usually if you know something they don't know, it's also insider trading.
Yeah, and you can go to jail if you try to exploit it. So
thanks, Larry and Jim. You've both had so much insight on these different questions that Jim has asked, that have come from the audience, that have sprung from the two of you based on the audience questions. But we do have a few more questions from the room left. But I would really encourage the room, if you have any more questions, or if you're, thinking of questions as Larry and Jim are talking, please go ahead and add those to the Q&A. Before I get to another question from the room, I had a question for Larry, actually. So Larry, I know that you have been in the past and are still a proponent of passive investing, and with Jack Bogle calling it a winner's game, there has been like a huge trend away from active and into passive in the larger market. Has that had an impact on the market? And if so, what? And how would that impact individual decisions about active versus passive investing?
Yeah. So we have seen this massive trend towards passive investing. It's gone from about just a few percent of individual money when I wrote my first book in 1998 to well over 30%. And the overall market, including institutions, is probably now right around 50%. That means there are a lot fewer active investors, but there are still tens of thousands of mutual funds that are active investors, hedge funds trying to outperform. So there's plenty of price discovery going on to keep the markets highly efficient in terms of prices. So in fact, while a lot of people were making the claims, of course, these are active managers making the claims, that as active managers disappeared, or the amount of money going into indexing increased, that active managers would be able to beat the market because there would be less information in terms of price discovery. The reverse has actually happened. And 20 years or so ago, when I wrote that first book, 20% of active managers were outperforming their risk-adjusted benchmark. Today, that number is down to 2%. Of managers are outperforming on a statistically significant basis. And that's even before taxes. And one of the reasons is that the massive change in number of people who are passive investing has resulted in a sharp decline in liquidity in investing because we have less trading going on from that perspective. And that means we have a lot more volatility in stocks. And that's what the evidence is showing. We're seeing bigger moves in individual stocks. And we'll also see trading costs going way up for active managers who have to pay market impact costs because when they want to get out, they can't trade patiently the way Dimensional does, for example. They don't care if they buy or sell a stock today or tomorrow. They think the price is right today and it'll be right tomorrow. So they trade literally every trade they do basically is only in 100 share lots. So the market doesn't see what they're trying to do. An active manager may have a big position, say in Tesla, and then there's an announcement by Musk, he's going to divert his attention to buy Twitter. So they decide I better sell Tesla. Well, if they try to sell it in a significant amounts, the stock price will drop sharply because there isn't the liquidity. So the two things that are happening is we're seeing more volatility because of less active investing, and we are seeing trading costs going way up, and that makes it actually much harder for active managers to outperform. So we still have plenty of price discovery, and the active managers today who and all of the sophisticated money managers of funds like Dimensional, they're the most sophisticated they have ever been. Their knowledge level is much greater than it was 50 years ago. All the academic research, the high-speed computers. That means the competition has gotten much tougher, and trying to outperform them is a huge hurdle to overcome. So I think, as I wrote in my book, for those of you interested in the subject, co-authored with Andy Birkin, we wrote a book called The Incredible Shrinking Alpha, which explains why it is becoming harder and harder for active managers to outperform, and will continue to do so despite the trend of increasing movement towards passive investing.
Awesome. Thanks so much for that comprehensive answer. And again, a shout out to one of your other really excellent books. Jim, there's a question that we got in one of the sessions earlier today that I wanted to ask. I wanted to make sure to ask to you. And also, Larry, if you have anything to add, please do. This is a question from Tom. He said, we have an adult child with disabilities who is now receiving SSI. What are the pros and cons of naming a special needs trust as a beneficiary of our IRAs after both of us die?
Okay. By the way, I like this question. And as many of you know, I do have a special needs child, and we have two substantial changes, actually three substantial changes that are very important for parents of a child who has a disability. In Tom's case, he won his SSI case. That's very big. That's very good. So for a couple of reasons. One, obviously that provides some income right now. The other thing, and this is just part of the proposed regulation, but the one of the exceptions to the income tax acceleration within 10 years of death of the IRA owner for the beneficiary to withdraw the money from the inherited IRA and pay taxes on that whole IRA within 10 years of death. One of the exceptions is if the beneficiary qualifies as a beneficiary who's considered disabled. And it wasn't really totally clear who would qualify as disabled, who would not. What if you won your Social Security case, as my daughter did also? Does that necessarily mean that you will be considered disabled for the purpose of qualifying for the exception, which will allow your beneficiary to stretch or to defer the taxes on the minimum required distribution of the inherited IRA over their lifetime compared to 10 years? And by the way, in an earlier webinar that we did yesterday, and I think we even did it again today, if you remember that, for those of you who were on, we had that chart and it showed the difference between qualifying for the exception and not towards the end of the beneficiary's life on $1 million bequest of an IRA to zero versus $2 million. So that was good news. Second thing, and again, this is, this is actually new law. There is something called the ABLE. And what that allows you to do, it's kind of like a 529 plan. All right, so you're putting money into this account, and this account is going to be growing income tax free. Presumably, they could be used either while you're alive or most likely after you're gone. And the difference between tax-free and taxable is going to, or even just plain old after-tax investments, is going to be significant. So that is another benefit. Both of these are really good news. So you get to stretch it in the event of a Roth. You're continuing to have more time that is allowing tax-free growth. The ABLE is going to be more tax-free growth. The ability to stretch is going to be really important. Now, sorry, so that's the warm-up answer. Now let's get to the special answer. Do you need a special needs trust? What is the purpose of a special needs trust? Let's assume, so there's a couple, and people have disabilities in various forms. In my case, our daughter is more frugal than I am. So I'm not worried about her making stupid financial decisions. On the other hand, she may or may not qualify for some benefit, some government benefit, maybe a state benefit, a federal benefit. In our case, we have decided she's not likely to qualify for these benefits. So a special needs trust isn't as important. Let's say, and even the SSI relative to the ability for her to be able to do what she wants with the money. In our case, we're going to do both. We're going to have a special needs trust, and then we're going to have other monies that she will have complete access to. But in sometimes the need to qualify for a government benefit, and again, benefits come in different ways. It could be SSI, SSDI, it can be a housing benefit, it can be a drug benefit. There's various benefits available to children or adults with disabilities. And by the way, the same thing would apply to chronically ill, and there's specific definitions of each one of those. If that child or if that beneficiary has a lot of money on their own, that will disqualify them from many of the government benefits. In other words, many of the government benefits are based not just on disability or chronic illness, but they're also based on need. So what attorneys have done is they have said, okay, the kid needs money for certain purposes, but we also want to take advantage of the government having any government benefits. So what they've done over time is we've learned what language works and what language doesn't work. And so rather than leaving money directly to the beneficiary that has the special needs or chronically ill that might disqualify them from the government, we leave money in a special needs trust with I tend to prefer family members, but you might use a financial institution or a bank that can distribute money to that special needs child, but still they will qualify for the government benefit. So that way you get the best of both. I've seen a lot of people do this wrong. I'll give you an example of one time. And by the way, sometimes the wrong way will work, but some people will leave all their money to the child who isn't disabled with the oral understanding that they will use that money to take care of their disabled sibling. And maybe that works many times, but maybe through a lawsuit, maybe through a divorce of the able child, they lose a lot of money. and the money that was intended for the child with a disability is gone. There's all kinds of problems with it. A special needs trust is a very good solution, and probably I would say the majority of the cases of children that have a special need. And then to complicate life, if you are IRA and retirement plan heavy, you also want to meet the 5 special conditions in order to qualify the inherited IRA as a designated beneficiary that will allow the stretch IRA. So, for example, just because the government says, okay, you can do it, the government is assuming that you're going to qualify under each of those 5 specific conditions. So you really want to go to an estate attorney who knows what they're doing when they are drafting. First, they should know this should not be the only trust that they draft with children with disabilities. And not only that, they should also have the expertise in the IRA and retirement plan drafting for when the underlying asset is an IRA or a Roth IRA.
Absolutely.
Long question to a short question.
Yeah.